Now let's get into economics. I call it the sugar high economy. The economy continued to recover across state and country, propelled largely by what? Stimulus. Stimulus from our federal government, stimulus from our central bank, the Federal Reserve. So the big question is, how will 2020 be with the stimulus starting to come out? Let's look at this past year. First, we'll start with U.S. GDP. As we all know, first quarter of 2020, the economy took a hit when COVID started moving and the very beginnings of the lockdown started. And then we had the biggest collapse in GDP in our country's history, down 31.2%, unprecedented as we shut down the economy. Then, ironically, the very next quarter, as all these stimulus checks went out and people were stuck at home, started spending money, fixing up their homes, buying boats, buying bicycles, all the rest, the economy flew. And then the economy continued to pick up and pick up. Now, recall when you have a drop, a percentage drop, that's a bigger impact than the number going back up. You have to have a bigger percentage going back up. Real simple. You're at 100, you go down by 50, you go to 50. To get back to 100, you have to go up 100. So the fact that we went down 31.2%, and I can't remember the amount we went down in first quarter, but that meant we had to have growth of 53% to get back to where we were pre-lockdowns. The good thing is we have achieved that. The economy has put together growth where our GDP is now above where it was previously. And our GDP is now at $23.2 trillion. Now here's what's probably been the biggest driver of it, retail sales. Again, very interesting dynamic. Things fell off a cliff when the lockdown first started. This is monthly, month over month, and just got cratered in April. And then we had the skyrocketing boom back up as, again, people stuck at home started spending money. And it was tied directly to their stimulus checks. And then it started coming back as that stimulus came out. And then recall, there were 2 more stimulus checks, one at the end of the year and then at the beginning of 2021. Now retail sales have settled in, up 0.8 last month, still relatively good. But the question is, how long can this last? How much spending did we pull out of the future and bring into now? You know, you can only do so many improvements on your home. You can only buy so many bikes. Now, we're going to see some shifting in spending. There's no question. You're going to see a lot more spending in restaurants, air travel. It's already happening, hotels. So there's a variety of different areas that you're going to see an uptick in spending. But can it be maintained at this level? This is the manufacturing index. That red line is 50. The way they measure this is anything above 50 is expansion. Anything below 50 is contraction. We have been at a very high level of expansion. Again, a lot of it generated by all this consumer spending. Factories having to put it into high gear and produce a lot of goods. Next. Okay, this is weekly and initial jobless claims. Recall when the lockdowns first started, unemployment just spiked. I mean, went through the roof. We were the highest initial jobless claims prior to this was sometime in '81 when Volcker had to take interest rates to 18-20%. I think it was 600,000 a week, and we were running at 7 million a week. At its peak. Continuing claims peaked out at 23 million people. Now here's the good thing. Look at how those lines have collapsed back down as the economy has recovered and started to restore itself. We're not quite back, but we're pretty close to where we were before this whole thing started. Great news. This is the long-term unemployment rate. Again, big spike back down. Right now, we're at 4.8%. We peaked out at 14.8%. We're not to where we were pre-pandemic, which is 3.5%. And the way I measure unemployment is not, the headline, it's U6. They give you the U6 at the same time. Why is U6? Because it gives you a bigger perspective into unemployment, because U6 factors in disenfranchised workers, people that are working part-time, that would like to have a full-time job, and people who are loosely tied to the labor force. But still, pretty good at 8.5, not quite to the pre-pandemic low of 7%. This is a very interesting graph. This is the labor participation rate. And what does that mean? It tells you what percentage of our population is actually in the labor force. In the 50s and 60s and early 70s, we only operated about 55, high 50% of our population in the workforce, because most women stayed at home, raised their kids. Then, with the advent of the late 70s and 80s, women flooded into the job market, and our participation rate just kept moving up and up and up, and it peaked out in, well, I think it says it here, at 67.3% in March of 2000 during, turn of the century. Now it has been continuously moving down, and it took a big collapse, and we've lost about 3 million people permanently out of our workforce. Now, part of that is the baby boom generation. A lot of people with, COVID coming, they're getting close to retirement anyways, just said, you know what, I'm done, I'm out, I've saved up enough, the equity markets have treated me well, I'm cashing out, and so they've just left. But here's the weird thing. Another big chunk of it is the younger population. Middle-aged population has stayed the same. It's our younger people. There is something going on with our younger people not entering into the labor force like they have in the past. I fear part of it could be the big chronic drug problem that our country has had with opiates. I think part of it is kids haven't been taught the same work ethic that the baby boom generation has. There could be a variety of different reasons, but there is this trend line that younger people are not as incorporated into the labor force as they have been in the past. But we need to get some of these jobs back. To have an economy really functioning well, we really want to see that participation rate jump back up. Averagely hour earnings, again, weird dynamic. We talked about this last year. Big spike up when employment is crashing. How the heck did that happen? Well, part of it was stimulus checks, part of it was the supercharged unemployment, but another big part of it, as blue-collar jobs fell off and white-collar jobs stayed, the higher income people were still employed, so that naturally spiked that up. Then it came back down as blue-collar labor started coming back into the labor force, and now it's moved back up, and it's probably settled in kind of where it will be, which is at a higher level than what we've seen for a very long time. And that ties into inflation, which we'll be getting into. All right, so we had history's most expensive sugar rush. Never seen anything like it where a government put that much money into economy. Never did it in the Great Depression. Didn't do it in the Great Financial Recession. These are the different packages. Most of you know about the CARES Act in 2000. March of 2000, PPP was first launched, the first set of stimulus checks, the bailout for the airline industry, a whole host of things. $2.2 trillion. Let's put that in context. During the Great Financial Recession, we spent $787 billion. And let me tell you, there were more structural problems during the Great Financial Recession than there were during COVID. COVID was a shock because we shut down the economy. So we really pumped the money in, but then they kept going. There was $400 billion in other related bills. Then in December, they pumped another $900 billion, another round of stimulus checks. And then when President Biden came in, And the Democrats, they shoved another $1.9 trillion. More stimulus checks. A lot of it was just pure politics. President Trump, we should pay $2,000, and then because the Georgia elections were coming up, oh, we Democrats, we will give you the money. They were running ads in Georgia saying, if you vote for our senators, we'll send you the $2,000. So a lot of it was politics, and unfortunately, there's going to be cost to this. So we've spent $5.4 trillion, an ungodly amount over just a very short period of time. So what's the consequence of that? We're running deficit last year, ran it at $3.1 trillion. Yes, $3.1 trillion. And this year it's estimated to be $3.4 trillion. Folks, we're running in 1 year deficits that are more than 13% of our GDP. That is so unsustainable, it's not even funny. I mean, it's like Washington, D.C. has lost any kind of sense of fiscal responsibility. It has never been good for the last 15 years, but now it's just downright terrible. Central bank, this is the Federal Reserve's balance sheet. Why am I showing you this? Because this has as much of an impact as all the spending that they're doing. Now, what are these lines? Okay, first if you see from 2002, and you could take this back decades, it's always kind of been a consistent line, largely made up of the red line, which are U.S. Treasuries. That's how the Federal Reserve managed their balance sheet. Then all of a sudden, you had this huge spike up. That was in 2008, end of 2007, 2008, during the Great Financial Recession. The Federal Reserve came in and started buying more treasuries, but they also started buying MBS and really expanding that. So their total assets, because they were trying to repair the housing market. Then they kind of tapered it off in 2011, 2012. The economy wasn't growing enough for them, so they jammed more money. And they eventually grew their balance sheet to about $4.6 trillion. So they put basically $4 trillion over a stretch of period of years into the economy to liquefy the economy. Then they started taking it out in 2018. The equity markets had a big hissy fit, if you recall. And then they started growing it gradually. And then all of a sudden COVID happened. Boom! They went off to the charts. Treasuries, mortgage-backed securities, their whole balance sheet just massively expanded. They sent $3 trillion last year into the capital markets and another $1 trillion this year.